In the early 2000s, Wall Street's language was filled with one word that sounded harmless but carried enormous pressure: edge. Every hedge fund wanted it. Every trader was measured by it. In that climate, Raj Rajaratnam built Galleon Group into one of the most watched hedge funds of its era, known for sharp calls on technology and growth companies. To many outsiders, it looked like a classic story of ambition and intelligence, a disciplined investor turning information into insight. Rajaratnam's reputation grew alongside the market's appetite for fast answers. Tech companies were releasing earnings, guidance, and product news at a pace that made yesterday's analysis feel outdated. In that environment, even small timing advantages could become meaningful. Being early by a day or even an hour could transform an ordinary trade into a standout result. Galleon's performance helped reinforce the idea that Raj Rajaratnam had a special ability to anticipate outcomes before the crowd did. But finance has a quiet paradox. The more competitive the game becomes, the more normal it can feel to push boundaries. Research is celebrated, industry expertise is encouraged, networking is practically a job requirement. Investors speak with executives, suppliers, customers, analysts, consultants, anyone who can help them understand a business. Most of this is legal and healthy for markets, yet the same pathways that carry legitimate insight can also carry information that is not meant to be shared, not yet public, and not equally available to all participants. Rajaratnam operated in a world where conversations were currency. A single detail, an unannounced earnings shift, a pending deal, a private change in guidance could act like a shortcut through uncertainty. Markets move on expectations, and expectations move on narratives. When an investor hears something that shapes a narrative before the public does, it becomes tempting to treat that knowledge as just another input. The dangerous step is when the investor stops asking where the input came from and whether it was meant to be public. Galleon did not grow only from trades, it grew from relationships. Rajaratnam cultivated networks across technology, finance, and corporate leadership. He was known as someone who asked direct questions and valued speed. In a competitive culture, speed can become a virtue that crowds out reflection. When people are rewarded for being first, they become less careful about whether first is also fair. Over time, a person can start to treat the market as a contest of access rather than a contest of analysis. This is the first major lesson of the Galleon story. Wrongdoing in markets rarely begins with a dramatic moment. It often begins as a gradual shift in what feels acceptable. A trader convinces themselves that they are simply well connected. A source convinces themselves that they are simply helping a friend. The language becomes softer, the lines become blurrier, and eventually the behavior no longer feels like a choice. It feels like the price of staying competitive. In educational terms, insider trading is not about being smart, and it is not about being lucky. It is about using important non-public information in a way that undermines trust in markets. Markets function because participants believe that prices reflect public information and legitimate analysis, not hidden advantages. When that belief erodes, investors become less willing to participate, and the entire system pays a cost in credibility. What made Raj Rajaratnam's case so instructive was not only the scale of the fund or the fame of the people involved. It was the way the story revealed a broader ecosystem, professionals across roles who each held a small piece of sensitive information, and a culture that sometimes treated those pieces like bargaining chips. The case became a mirror for the industry, reflecting how quickly professional ambition can turn into rationalization. At this stage of the story, it is important to keep the tone clear and calm. The point is not to glorify shortcuts. The point is to understand how they form, how they spread through networks, and why they eventually attract serious scrutiny. Galleon's rise shows how success can create momentum that makes ethical questions easier to postpone until the questions return in a much louder form. In the next part, we'll examine how information networks can drift from legitimate research into prohibited territory, often without the people involved admitting to themselves that they crossed a line until it is too late. Professional investing depends on learning faster and thinking clearer than the crowd. That is the ideal. Yet in the real world, learning faster can sometimes become a hidden contest of access. The Galleon story is powerful because it shows how an information advantage can shift from thoughtful research into something far more fragile, reliance on details that were never meant to leave private rooms. To understand this, it helps to break information into categories. There is public information, earnings reports, press releases, conference calls, regulatory filings, public interviews, and broad industry data. There is also analytical interpretation. A fund studies supply chains, surveys customers, models revenue, compares competitors, and forms a view. This is normal market discovery. Then there is the category that creates legal and ethical danger, material non-public information, details that are not publicly available and could reasonably influence an investor's decision if they were known. Materiality can include earnings changes, merger talks, major contract wins or losses, significant product delays, or shifts in guidance. The non-public part matters because markets assume such information becomes usable only after it is shared fairly through public channels. In the Galleon case, Rajaratnam's network included people who had proximity to sensitive corporate updates, executives, employees, advisors, and industry professionals. The structure of modern business makes these people common and reachable. Conferences, alumni networks, and professional circles bring decision-makers and investors into the same social orbit. That closeness is not inherently wrong. The risk begins when someone shares what they know before they are allowed to share it, and when the recipient acts on it. One reason these situations escalate is psychological. People often tell themselves a comforting story. This is just color. This is just my opinion. Everyone hears things. Over time, the difference between opinion and information can blur. A person may start to treat a precise earnings figure, a pending board decision, or a not yet announced deal as if it were simply good intuition. Another reason is social reciprocity. Networks operate on exchange. If one person provides useful insight, the other may feel pressure to return value. Introductions, career help, prestige, or future favors. These exchanges can create quiet incentives that push people toward risky disclosures. What begins as informal conversation can become a routine. Routine becomes expectation. Expectation becomes dependency. In educational compliance training, a key phrase appears again and again. If you wouldn't be comfortable seeing it on the front page tomorrow, it may not belong in the conversation today. In practice, that means asking simple questions in real time. Is this detail already public through widely accessible channels? Is the source authorized to share it? Does it sound like a specific internal update rather than a general industry view? Would trading on it feel defensible if reviewed later? The Galleon story also illustrates how status can distort judgment. When a fund becomes successful, sources may feel flattered by attention. They may enjoy being seen as influential. They may underestimate the seriousness of what they share because it feels like casual talk. Meanwhile, the investor may feel entitled to the information because of their reputation. Success can quietly convert humility into expectation. Of course, people tell me things. A subtle but important feature of these cases is that the information often arrives in fragments. No single conversation seems dramatic. Instead, a pattern forms. A hint here, a confirmation there, a timing detail elsewhere. The investor pieces it together and acts. When regulators later reconstruct the chain, the pattern becomes much clearer than it looked in the moment. What felt like just staying informed can look like systematic reliance on private corporate knowledge. From a market integrity perspective, the harm is not only about profit. The deeper damage is trust. Markets are supposed to reward analysis, patience, and risk-taking based on public facts. If investors believe outcomes are driven by private whispers, they become skeptical, disengaged, and less willing to invest. That skepticism raises the cost of capital for companies and reduces confidence in the system. This is why major enforcement actions tend to focus on networks, not just individuals. Regulators look for repeated contact, suspicious timing, and patterns of trading that align too neatly with non-public events. The story of Galleon became a warning that modern networks can create modern risks, and that everyone does it is not a defense when the evidence shows a consistent structure. In the next part, we'll follow how investigators began turning a complex web of relationships into a clear narrative, and why the methods used in this case became a turning point in financial enforcement. Large financial cases do not begin with a single dramatic discovery. They often begin with anomalies, timing that looks too perfect, trades that repeatedly align with confidential events, or networks that seem unusually productive. The Galleon investigation became a landmark, not because it introduced suspicion into Wall Street, but because it showed how suspicion could be converted into a courtroom-ready story. Regulators and investigators generally rely on a mix of signals. The first is trade timing. When a fund consistently buys shortly before positive announcements or sells shortly before negative ones, it can raise questions. On its own, good timing is not illegal. Skilled investors can anticipate outcomes. But when timing becomes consistently precise across multiple companies and multiple events, the statistical shape of it starts to look less like skill and more like advanced knowledge. The second is relationship mapping. Investigators analyze who speaks to whom, how often, and in what sequences. They compare communication logs with trading activity and corporate event timelines. The goal is not to punish networking. The goal is to see whether networking appears to function like a pipeline for restricted information. When the same names reappear around multiple sensitive events, the picture becomes harder to dismiss. The third is narrative consistency. Investigators try to understand how the trader would explain the decision using legitimate research. They ask, was there a documented thesis? Large financial cases do not begin with a single dramatic discovery. They often begin with anomalies, timing that looks too perfect, trades that repeatedly align with confidential events, or networks that seem unusually productive. The Galleon investigation became a landmark, not because it introduced suspicion into Wall Street, but because it showed how suspicion could be converted into a courtroom-ready story. Regulators and investigators generally rely on a mix of signals. The first is trade timing. When a fund consistently buys shortly before positive announcements or sells shortly before negative ones, it can raise questions. On its own, good timing is not illegal. Skilled investors can anticipate outcomes. But when timing becomes consistently precise across multiple companies and multiple events, the statistical shape of it starts to look less like skill and more like advanced knowledge. The second is relationship mapping. Investigators analyze who speaks to whom, how often, and in what sequences. They compare communication logs with trading activity and corporate event timelines. The goal is not to punish networking. The goal is to see whether networking appears to function like a pipeline for restricted information. When the same names reappear around multiple sensitive events, the picture becomes harder to dismiss. The third is narrative consistency. Investigators try to understand how the trader would explain the decision using legitimate research. They ask, was there a documented thesis? Was there public news that reasonably supported the trade? Were analysts' notes aligned with the action, or did the trade appear suddenly after a private contact? This is where compliance culture matters. Firms that record research processes can show a credible trail of reasoning. Firms that rely heavily on informal calls and undocumented tips are more exposed when questioned. In the Galleon investigation, the investigation came to represent a shift towards stronger evidence building. The story that emerged, according to widely discussed public accounts of the case, was that authorities moved beyond simple market surveillance and constructed a detailed view of communications, relationships, and timing. The case became famous for showing that sophisticated financial wrongdoing could be investigated with sophisticated tools, and that the distance between a private conversation and a public trade could be traced with surprising clarity. This had a chilling effect on a certain style of information culture. For years, some market participants believed that enforcement was unlikely unless someone openly admitted wrongdoing. The Galleon case challenged that belief. It suggested that patterns could speak even when people tried to keep their language vague. It reminded the industry that investigators can look at context, the time of the call, the urgency of the trade, the size of the position, the immediacy of the profit or avoided loss, and the repetition of similar sequences. From an educational standpoint, this part of the story is not about tactics, it is about accountability. The takeaway is that modern markets generate records. Calls leave logs, messages leave trails, orders leave timestamps, corporate events leave calendars. When those layers are stacked together, the narrative can become difficult to explain away. The investigation also highlighted a key truth. Often enforcement depends on human weakness, not just data. Networks involve people, and people sometimes talk when pressured, sometimes seek leniency, and sometimes try to protect themselves by revealing what they know. Once cooperation begins, a complex network can unravel faster than outsiders expect. What looked like a tight circle can turn into a set of individuals, each trying to reduce their own exposure. In calm, non-sensational terms, this is why compliance programs emphasize both training and culture. Training teaches rules, culture teaches habits. A culture that encourages employees to pause, document, and escalate concerns can prevent risky behavior long before any investigation exists. A culture that rewards speed at all costs can produce decisions that feel clever in the moment but look indefensible later. As the Galleon investigation progressed, it moved from suspicion to structure. Who had access, who communicated, what was shared, when trades happened, and how profits aligned with events. Once that structure was established, the story could be presented in a way that a court could evaluate. In the next part, we'll look at the courtroom chapter, how legal arguments, evidence, and public scrutiny turned a hedge fund legend into a defining case about market fairness. When a major insider trading case reaches trial, the courtroom becomes more than a legal venue. It becomes a stage where society debates what markets are supposed to be. Are markets a competition of research and risk, or a competition of private access? The Raj Rajaratnam case became widely remembered because it forced that question into the open. At trial, the core issue is typically not whether a trader is talented. It is whether the trader used information that was both important and not available to the public, and whether the trader understood or should have understood the nature of that information. Courts examine not only trades, but the surrounding context, communication patterns, the closeness of relationships, and the timing that links private contact to market action. A recurring theme in cases like this is intent and knowledge. The legal system often asks, did the recipient know the information was improperly shared? Was there an obvious breach of duty by the source? Did the recipient encourage the sharing, reward it, or rely on it repeatedly? These questions matter because insider trading law is not meant to punish normal research. It is meant to protect a level playing field where corporate secrets do not become a private trading tool. The trial process also shows how markets and human behavior intersect. In everyday finance, people speak in shorthand. It looks good. Numbers will be strong. They're confident. In a courtroom, shorthand is no longer harmless. It is examined. The meaning of words, the frequency of contact, and the immediacy of trades can be interpreted as indicators of what was truly happening. Ordinary business language can become extraordinary evidence when placed next to the timing of orders. For the public, the case carried a simple moral message. Confidence in markets is not automatic, it is maintained. If investors believe a small group can reliably profit from private corporate information, the promise of fairness weakens. This is why enforcement cases often emphasize deterrence. The point is not only to address one fund or one person, but to warn an entire industry that certain behaviors carry serious consequences. The Rajaratnam case also became a reference point for compliance departments. After it, many firms strengthened policies around contact with corporate insiders and employees, use of expert networks and consultants, documentation of research reasoning, pre-approval processes for sensitive meetings, and monitoring of communications tied to trading windows. Even if many of these controls already existed, the case added urgency. It showed that regulators were willing to pursue complex networks, not just isolated incidents. It pushed firms to ask, are we managing risk at the level of individuals or at the level of systems and culture? Another lesson is reputational. In finance, trust is a form of capital. Clients allocate money based on confidence, not only returns. A scandal can erode that confidence quickly, affecting investors, employees, and counterparties. This reputational cost is often underestimated during the pursuit of advantage. People focus on the upside of being right and ignore the long-term cost of being questioned. Educationally, it is useful to highlight what ethical investing looks like under pressure. Ethical investing does not mean investing without ambition. It means treating boundaries as real, not flexible. It means preferring slower confidence over fast certainty that comes from questionable sources. It means respecting that corporate information belongs first to the public process, not to private relationships. The courtroom chapter of the story is also a reminder that success can be a weak shield. A high-profile career can create the illusion of safety, a belief that reputation will smooth over mistakes. But in legal matters, reputation can amplify attention rather than reduce it. A high-profile fund becomes a symbol. A symbol attracts scrutiny. Scrutiny demands clarity, and clarity is exactly what blurred boundaries cannot provide. In the next part, we'll shift from the drama of trial to the practical lessons, how organizations can reduce risk, how investors can think clearly about fairness, and why ethics is not merely a rule book, it is a strategy for long-term durability. After a headline case, the financial industry tends to move through two phases. First comes shock, surprise that such a large and connected network could be scrutinized so deeply. Then comes adaptation. Firms rebuild policies, training, and culture to reduce the chance of repeating the same mistakes. The most valuable part of the Galleon story, from an educational viewpoint, is what it teaches about prevention. A key insight is that risk is rarely located in a single person's character. Risk is often located in systems of incentives. If a firm rewards short-term performance without equal attention to process, people may learn that results matter more than methods. If managers praise being first without praising being careful, they unintentionally train employees to prioritize speed over judgment. Strong compliance programs try to reshape this balance. They do it not by assuming everyone is dishonest, but by accepting a human truth. Even good people rationalize under pressure. That is why compliance works best when it creates friction at the exact moment rationalization is likely to occur. Practical guardrails include clear definitions of material non-public information with real-world examples, restricted lists and watch lists for companies involved in sensitive events, pre-clearance requirements for trades in certain contexts, documentation norms that require research notes explaining why a trade is justified by public information, training on conversation boundaries, teaching employees how to stop a discussion politely when it drifts into sensitive territory. One of the most important cultural tools is a simple phrase, pause and escalate. If someone hears a detail that feels too specific, too timely, or too private, the safest habit is to pause and consult compliance rather than act. This is not weakness, it is strength. It protects both the individual and the institution. The story also highlights the risk of informal networks that blur roles. People often underestimate how easily a casual relationship can produce professional exposure. A friendly call with a former colleague can turn into a source of sensitive hints. A conversation with an industry contact can shift from general trends to private performance. The safest posture is consistent. Keep discussions grounded in public information and clearly framed opinions, not private internal updates. For investors, there is a parallel lesson. Build edge from durable inputs. Durable inputs include public filings, competitive analysis, management credibility, customer adoption signals, pricing power, and macroeconomic conditions. These are slower to build but safer and more repeatable. Shortcuts based on private access are unstable. They also create dependence. Once a trader relies on them, normal research can feel insufficient. There is also a leadership lesson. Many compliance failures persist because junior employees assume senior people want results at any cost. Leaders must be explicit about boundaries. They must reward employees who stop risky conversations, who document carefully, and who choose not to trade when uncertainty is high. Ethical behavior must be made visible and respected, not treated as an invisible baseline. Another educational angle is the role of risk monitoring. Firms increasingly use analytics to identify patterns that deserve review: unusual profits around announcements, repeated success in narrow time windows, and heavy communication preceding trades. The purpose is not paranoia, it is early detection. Early detection can correct behavior before it becomes a case. Finally, there is an integrity lesson for the broader audience. Markets are a shared system. Most participants never meet each other, yet they cooperate indirectly through prices and public disclosure. Fairness is not a sentimental ideal, it is a practical requirement. When fairness is weakened, participation drops, Trust erodes, and the system becomes less effective at funding innovation and growth. This is why the Galleon story remains relevant. It shows that the cost of blurred boundaries is not just legal exposure, it is the slow corrosion of trust inside firms, between firms, and across the investing public. In the final part, we'll zoom out to the long-term impact of the case and connect it to modern market realities, how the lessons still apply, and how individuals can pursue excellence without crossing lines. Years after the headlines fade, certain cases continue to shape behavior because they changed what people believe is possible. The Galleon case did that in two directions at once. It showed that private information networks can grow large inside a competitive industry, and it also showed that those networks can be reconstructed and challenged with rigorous investigation. The long-term impact is a shift in market culture, from casual confidence and secrecy to cautious awareness of records, patterns, and accountability. One lasting change was psychological. Before major enforcement waves, some market participants treated insider trading risk as distant, something that happened to reckless individuals, not to sophisticated professionals. The Galleon case disrupted that comfort. It suggested that sophistication does not reduce risk, it can increase it, because sophisticated networks create more points of exposure. Another lasting change was institutional. Many firms expanded their compliance infrastructure, not only in size, but in mindset. Compliance became less about annual training and more about ongoing behavior management, regular reminders, tighter policies, stronger monitoring, and clearer rules around external contacts. Even the way people described their research changed. Professionals became more careful about how they framed sources and how they recorded the logic behind decisions. The case also influenced the conversation around expert networks and consulting relationships. These services can be legitimate when they focus on public knowledge and general expertise. But the case highlighted how easily such channels can drift into unsafe territory when discussions become too specific or too close to corporate performance updates. The broader lesson is that structure matters. Clear contracts, strict training for experts, and firm boundaries for what can be discussed. From an educational standpoint, the most important message is that ethics and performance are not opposites. In durable careers, ethics is part of performance. A trader who depends on questionable information is not building a repeatable skill. They are building a fragile habit. A professional who builds insight from public data, careful modeling, and patient observation is building something that survives scrutiny and time. There is also a human story beneath the finance story. Networks are made of relationships, and relationships are made of trust. When people share restricted information, they often justify it as loyalty or friendship. But true loyalty does not ask someone to risk their career or integrity. True professionalism protects the other person by refusing to receive what should not be shared. This is why many compliance programs train employees not only to avoid acting on sensitive information, but to avoid receiving it in the first place. The Galleon case also offers a lesson to the public audience. Healthy skepticism is useful. Cynicism is not. It is easy to look at insider trading headlines and conclude that markets are purely rigged. That conclusion is emotionally satisfying, but often inaccurate. The more practical view is that markets contain both strong safeguards and persistent temptations. When safeguards are enforced, trust increases. When temptations spread without consequence, trust decreases. The answer is not despair. The answer is continuous improvement in transparency and accountability. Modern markets add new complexities, faster information cycles, broader digital footprints, and more ways for rumors to circulate. These changes make ethical boundaries even more important. When information moves quickly, the pressure to act quickly increases. That is precisely when people need stronger habits. Verify public sources, document reasoning, and accept that sometimes the correct choice is to do nothing until clarity arrives. If we summarize the educational takeaways of the Raj Rajaratnam and Galleon story in calm, practical terms, they look like this. Edge must be earned through analysis, not borrowed from private access. Boundaries must be treated as real, not negotiable. Systems shape behavior. Incentives and culture matter as much as rules. Documentation protects integrity. A clear research trail is a shield. Trust is a public asset. Fair markets benefit everyone. In the end, the story is not only about one fund or one individual. It is about a test that every competitive environment creates. When the pressure to win rises, do people protect the rules that make the game meaningful? The most sustainable answer, both for individuals and for markets, is to build success on methods that can be defended openly, calmly, and confidently, even years later.